How does the life insurance suicide clause work? Imagine buying a life insurance policy to protect your loved ones, only to worry about what happens if you pass away by your own hand shortly after. That's where the suicide clause comes into play. It is a part of most life insurance policies that sets rules about what happens if the insured person dies by suicide within a certain time frame. Typically, the clause applies for the first 2 years after the policy starts. During this period, if the insured dies by suicide, the insurance company usually will not pay the death benefit to the beneficiaries. Instead, they might refund the premiums paid so far. This rule helps prevent people from buying insurance just to benefit from a quick payout if they plan to end their life. After the initial period, usually 2 years, the suicide clause no longer applies. If the insured dies by suicide after this time, the policy treats it like any other cause of death, and the full death benefit is paid out. When a death occurs early in the policy, the insurance company investigates the cause of death. They look at medical records, death certificates, and the timeline of the policy to see if the suicide clause applies. If the death is within the exclusion period, the insurer denies the claim but often refunds the premiums paid during that time. However, this can vary depending on the policy and state laws. The suicide clause often overlaps with the contestability period, which is usually 2 years. During this time, the insurer can investigate and deny claims if they find misrepresentations or undisclosed information in the application. Most types of life insurance, including term life, whole life, and universal life policies, include a suicide clause, especially for the first 2 years. Some group policies through employers or military benefits might not have this clause, so they could pay out even if the death was by suicide. Understanding this clause is important because it protects insurers from financial loss and encourages honest health disclosures. It also helps policyholders know what to expect if a death occurs early in the policy. If someone dies by suicide within the exclusion period, beneficiaries should be prepared for a claim denial but might receive a refund of premiums. After the exclusion period, suicide is treated like any other cause of death, and the full death benefit is payable. Knowing how the suicide clause works helps everyone involved make informed decisions about life insurance coverage.